Welcome, everyone. If you're going to be a manager, an analyst, an entrepreneur, you need to speak the language of business. And that language, fundamentally, is accounting. Every single strategic decision you'll ever make, from a small operational change to a massive merger, is built on the principles we're starting with today. So let's dive in with the very first and maybe the most critical step: how a business officially records what it does.
Think about it this way. Every business is telling a story over time. A story of growth, of challenges, of innovation. But this isn't a story told just in memos or marketing materials. It's a story written in hard data. So the question for us as leaders is, where does that official story, the one that investors and banks will actually read, where does that first sentence get written? It starts right here, by turning every single economic event into a structured, formal record. This is the very beginning of all financial intelligence.
Just try to imagine the sheer volume of stuff happening in a business on any given day. You've got sales coming in, you're buying inventory, you're paying your employees, you're taking out a loan. It's a constant flurry of financial activity. If you don't have a system, what you have is chaos, a total storm of data that's impossible to understand. And you absolutely cannot make smart decisions for the future if your picture of right now is a complete mess. Accounting is the system we use to tame that storm. So that brings us to Section 1. How do we actually impose order on all that financial chaos? We need a formal, standardized system. We have to move from just random notes and receipts to a structured process that's built for accuracy and completeness. This is where the official financial story of the company truly begins. And the tool we use for this is called the journal entry. Now, the formal definition is right here. The first step in the accounting process, recording financial transactions in chronological order in the general journal. Let's pull that apart, because those phrases are critical. First step, that tells you everything else flows from this. Get this wrong, and everything that follows is wrong. And chronological order, that's non-negotiable. It creates a diary of the business's life, an auditable trail that shows exactly what happened and when. It provides context and ensures the story we're telling is accurate.
This slide right here shows you the big picture, the entire accounting cycle. And look where we are, right at number 1, record transaction. That's the journal entry. From there, that information gets posted to ledgers, then summarized in something called a trial balance, and only then can you create the financial statements, the income statement, the balance sheet that managers and investors actually use to make decisions. Now think about that. An error at step 1, a simple mistake, maybe a misplaced decimal point. That error doesn't just disappear. It flows through the entire system like a virus, contaminating every single step after it. You end up with flawed reports, and you start making bad decisions about hiring, pricing, everything. All because that first step wasn't solid.
Okay, Section 2. Now that we understand just how important this is, we need to learn the specific structure of a journal entry. You can think of it like learning grammar. It has rules, a specific syntax. And following these rules isn't optional. It's what makes the language of accounting universal and reliable. So let's break down the components. So every complete journal entry needs these 5 things. First, the date. Obvious but essential for that chronological record. Second, a brief explanation of what happened. Third, a reference number, which is like a tracking number for every transaction. And then, the heart of the entry, the debit and credit accounts and their amounts. This is the part that shows the two-sided nature of the transaction. All 5 pieces are important, but getting the debits and credits right, that is the core skill we need to master.
And this is what it looks like. This is our canvas, the standard format for a general journal. It might look simple, but this structure is a globally understood language. You've got your columns for the date, the account titles and explanation, that reference number, and then the 2 most important columns, debit and credit. Mastering how to fill this out correctly is the foundational skill for literally everything else we're going to do. So let's actually do.
Which brings us to Section 3, a transaction story. You know, theory is one thing, but accounting really clicks when you apply it. We're going to take a very common business event and translate it step by step into a proper journal entry. We're moving from a real-world action to its official accounting record.
Okay, here's our scenario. We have a new company, Bayside Web Design, and they just bought a new laptop for $1,200. They paid for it with cash. Simple enough, right? So the first step isn't to start writing. The first step is to analyze. We ask ourselves, from a financial point of view, what just changed? Well, the business gave up one thing it owns, cash, to get another thing it owns, a laptop. It's an exchange. Now let's translate that exchange into the language of accounting.
All right, let's build this entry together systematically. First, the date, January 10th. Easy. Now we analyze the effect on the accounts, and we always ask two questions. Question 1. What did the business get? It got a laptop. In accounting, a long-term resource like that is called equipment, which is an asset. And here's rule number 1. To make an asset account go up, you debit it. So we list equipment and put $1,200 in the debit column. Question 2. What did the business give up? It gave up cash. Cash is also an asset. And here's rule number 2. To make an asset account go down, you credit it. So we indent the next line. That's just a standard formatting thing to make credits easy to spot. We write cash, and we put $1,200 in the credit column. And look at that. Our debits equal our credits. The entry is in balance. We add a reference, J1 for our first journal entry, and a quick note. And that's it. A perfect, complete, balanced journal entry.
Now this slide is absolutely crucial. I need you to forget any everyday meaning you have for the words debit and credit. In accounting, a debit is not bad and a credit is not good. They are purely directional terms. A debit just means an entry on the left side, and a credit means an entry on the right side. That's it. In our laptop example, the debit recorded the increase in our equipment, and the credit recorded the decrease in our cash. The beauty of this system, which has been around for hundreds of years, is that for every transaction, the debits will always equal the credits. It keeps the whole system perfectly in balance. One asset went up, another asset went down by the exact same amount. The total value of what the company owns didn't change, it just changed form. Okay, section 4, the source of all truth. We just did one little entry. It might seem like a small administrative task, but now we need to connect this tiny action back to its massive strategic importance. Why is getting this right absolutely non-negotiable for making good decisions?
This principle right here is the foundation of financial trust. By recording things in the order they happen, we create that verifiable sequential history, what accountants call an audit trail. This trail means that anyone, a manager, an auditor, an investor, can pick a number from the final financial statements and trace it all the way back to the original journal entry that created it. Without that organized chronological trail, the data would just be a bunch of numbers with no proof. It would be totally untrustworthy.
Now, as future managers, knowing where things can go wrong is just as important as knowing how to do them right. Let's focus on the most dangerous mistake on this list for decision-making, debiting the wrong account. Let's say instead of debiting equipment, an asset, we accidentally debited office supplies expense. What's the damage? Well, on your income statement, your expenses for the month would be $1,200 too high, making your company look way less profitable than it actually is. And on your balance sheet, your assets would be $1,200 too low, making the company look smaller and less valuable. A manager looking at those reports might decide to cut costs or stop hiring. An investor might decide not to invest. One simple classification error creates a completely warped view of reality, and that leads directly to bad strategic choices.
So I'm going to leave you with this final thought to really chew on. If the foundational data, this very first record of what happened, is wrong, is it even possible for any analysis you build on top of it to be right? Can any strategic decision that comes from that analysis be the correct one? The answer, of course, is no. The quality of high-level corporate strategy is tied directly to the accuracy of these simple, foundational journal entries. That is the critical link between daily accounting work and successful business leadership. And that's why we're starting our journey right here.